years of dividend growth. And if you're a math major, you can probably figure out where we're going to go with that dividend in 2011. Not hard to figure. It's kind of been pretty steady increases there. And the dividend is funded primarily from Alagasco. We take all the cash flows of our E&P company and we reinvest those in growth. Utilities typically have paid out a dividend. So one of the advantages of owning Alagasco, while the yield is not particularly high, it's about 1.6% in that neighborhood today. There are many shareholders who like the fact that we pay a dividend and probably would not own the stock did we not. I talked about the financial strength. One of the things the company was able to do, and I'll show you in a minute, we invested a lot of capital in E&P, several $billions. But as gas prices rose, and as oil prices rose from that $18 a barrel and that $2 an MCF, we delevered the company. In fact, when the Great Recession hit, you can see our debt to cap, and we've done 3 acquisitions, is only 18%. It was only going to be 15%. So we found ourselves in a unique opportunity of having an unlevered balance sheet and a lot of cash flow at a very, very good time. And we were able to capitalize on some acquisitions then that have really helped the company grow its oil. We also just recently entered into a $1 billion credit facility to ensure that we would have access to capital when we need it for acquisitions. $850 million at Energen Resources, $150 million at Alagasco. We were relying prior to that on bilateral lines of credit that totaled up to about $500 million. A credit facility just means that the banks are committed to loan the money to you for a 3-year period of time at set prices that you've built in from an interest rate perspective. Gives us a lot of flexibility as we look at deals in the marketplace. The other thing we talk about at the company that's good, right now this is good for Robert, natural gas prices are low, and by the way, the 2 subsidiaries have no intercompany transactions with each other. So Energen Resources doesn't sell gas to Alagasco. They're 2 standalone subsidiaries. But right now, with gas prices relatively low, really at historic lows of about $4 per MCF, it's really important that our company has a large component of liquids. And when I talk about liquids, I mean oil, 30%, and natural gas liquids, which are then converted into propane, butane, and ethane. So that really helps carry the profitability of the company because oil is trading at very attractive prices right now. We have also been big believers in reducing commodity price risk. We're in a commodity business on the exploration and production side. We're producing oil and gas. You can hedge those commodities in forward markets. I'm sure, well, you guys may be too young. Anybody familiar with Trading Places? That movie with Eddie Murphy? Oh, we got some nostalgic people. I know Charlie's seen it. Well, just as they did in Trading Places, and they were trading corn futures, and it was a really good comedy, we can lock in future prices on the forward strip. And so if you look at this particular graph here, what you'll see is we made a very good decision to hedge 54% of our natural gas at $6.76. We made this decision actually in 2009. As I was telling you, the strip price for natural gas is around $4 right now, so we're in the money $2.76 per MCF. And since we produce about 66 million cubic feet of gas, that's about $130 million to the company. We don't know which way the market's going to go. Don't want you to misinterpret that we think that we do hedging because we think we're good at it and we know where gas or oil prices are going to do. We do it to lock in cash flows and lock in certainty. So if we see good prices out there, we'll capture them. If we actually have higher prices, we're happy because we're not hedging everything that we've got. So I mentioned our capital investment, and you can see the total investment here that we've put in that side of the business is right at $4.6 billion over this 15-year period of time. You can also get a sense for who we've bought from in the San Juan Basin, our major acquisitions. We have typically bought from either major oil and gas companies that you would recognize the name of, like Chevron, BP. We look for orphan properties that they sort of have not spent a lot of time on. Their trash becomes our treasure. We hope that we can mine additional resources or reserves out of those properties because they were not as focused on them as a smaller company would be. You also can see that some of our opportunities have been private sellers who have not had enough capital to drill their properties and have chosen to cash out. So that's really the combination of folks we bought from. $4.6 billion to acquire and produce almost 3 trillion cubic feet equivalent at a reserve cost of about $1.62. Now, it sounds a little high when gas is at $4, but I would remind you a good bit of that's oil, and the conversion rate for oil is about 6 to 1, so the oil price is about $10 a barrel. So when you look at it that way, it's a very attractive all-in finding cost for the company. I mentioned what do we do other than buy the commodity and hope that prices go up, and that's really not what we do. We buy the commodity, try to neutralize for prices, and then rely on our expertise to increase the value from that property. It's really what this slide demonstrates. When we buy these properties, we booked about 1.8 trillion cubic feet of reserves as proved. We found another 912 billion cubic feet of reserves. Guys like Ben and geologists and engineers worked these properties and found other reserves for us to get out of the ground that people didn't know about at the time they sold it. And so we've been able to increase the reserves by about 50% on all the properties that we bought. And that's really a phenomenal number. It's a number that has really juiced the overall return for investors. So a couple of acquisitions that you may have seen in the paper. Just a few weeks ago, the paper ran a story, the Birmingham News. We were on the cover of the business section. Energen buys, I don't like the headline, buys $1 billion worth of land in the Permian Basin. But nonetheless, the article was pretty accurate, even though the headline might not have been perfect. We just bought about 20,000 acres in the what's called the Wolfberry Trend. That sounds like a cereal, Wolfberry Crunch, for those of you who are not familiar with oil and gas formations. But really what it is, it's a combination of two layers of rock, one the Sprayberry and one the Wolf Camp, that now oil companies are combining those two reservoirs together and making very, very economic wells when we weren't doing that before. So we've picked up about 20,000 acres there. We think there's 50 million barrels of oil located in those 20,000 acres. We paid $260 million for it up front. We're going to spend another $755 million to develop it. It's got about 24 drilling locations, mostly oil and mostly natural gas liquids. Right? Why? Well, the price of natural gas is pretty low right now. The economics are not as good on that side. We actually think gas prices are going to stay low over the short term, which again is good for customers. It's good for Robert, helps him sell his product a whole lot easier. But this is the type of thing that we're looking at doing. These are the kind of investments that we've been making. And about 18 months ago, I mentioned the Great Recession hit, and we bought an oil property from Range Resources, and we really got a fire sale on that. We got a very good value because nobody had the capital to buy, and they were desperate to sell. Now, things have eased up now. As you know, capital is actually pretty easy to access right now, and I think actually debt capital is at historic lows. So I talked about our focus on oil on the acquisition side. Let me just show you our development capital. In 2011, now remember I said when we started, we were kicking off this bold plan in 1995. We were going to invest $500 million. Employees looked at me like I was absolutely crazy. We're going to invest almost $500 million in 2011 just on the properties that we own, not including the acquisitions that we might do. So we have really ramped the company up since 1995. And if you look there at the Permian, you're going to see that we're obviously, Robert mentioned capital allocation. We believe that our number one duty, stewardship to shareholders, is capital allocation. We're not for growth's sake. We're all about return on investment. We're all about cash flow. Every acquisition that we make goes through rigorous cash flow, discounted cash flow modeling, and that's how we look at it. So we're not worried about whether we grow our gas production. We want to invest our capital where the best return are for shareholders. And if that means buying the stock back, it could be buying the stock back. It could be developing our properties. In this case, the way we're going to create that value is by putting most of our capital into oil because I mentioned oil's trading now above $80 a barrel. Great, terrific economics there. I won't touch on this long. This is just our unproved inventory here of 1.9 trillion cubic feet. It's where we go get our proved reserves as we develop our properties further. And what it shows you is we've got 1.6 trillion cubic feet of proved reserves. We've got another company sitting in here in inventory that we can bring online over time. So to sum it up before I make a couple of energy comments, what I would tell investors is here's a company with a very good hedge, an excellent balance sheet, very under-levered. I mean, we believe we could add another $1 billion to the balance sheet and still stay investment grade. So what's management going to do with that opportunity and how might that create shareholder value? We've got very, very good cash flows, got a proven track record at doing this well, got a very good position in oil properties and liquids. So let's talk about natural gas. Why are natural gas prices low now? I thought gas prices were high just 3 or 4 years ago, and they were. They were very high. Natural gas got up to above $10 an MCF out in the field. But the game has changed. It's dramatic. 4 years ago, if I had been talking to you, I would have said, you know, I don't know if we're going to be able to keep pace with the demand for natural gas. And there has been a new development called shale gas. You may have heard about it. You may not. It's actually on TV a lot. It's being talked about on CNBC. It's being talked about by policymakers. And we now think, if you look at sort of the colors in red there, these are all the different shale plays. And to not bore you a lot, but that's where the gas was formed. You know, when you went to school and they said the dinosaurs died and the plants and it all got cooked up and the natural gas, it was formed in shale and then it leaked out over millions of years into sand, kind of like beach sand. And we used to drill in the beach sand and it would produce